Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of pre-immigration tax planning. The most important aspect of the title of this presentation is you got to do the planning beforehand. If you find yourself in a situation where you didn't plan beforehand, there could be some significant tax consequences which may not be that easy to unwind, especially if you're a green card holder, you became naturalized, you're a long-term resident for expatriation, exit tax purposes. So we're just going to kind of go through the basics. If you decide that you need more significant pre-immigration tax planning, you should contact whichever attorney you choose and go through it in some more detail. But here are some of the basics. First of all, who is considered a U.S. person individual, right? We're just dealing with individuals for today. It's not just citizens. There's actually three categories of people who are taxed on their worldwide income. A U.S. citizen, either by birth or naturalization, a legal permanent resident, or a visa holder or other foreign national who meets the substantial presence test. This third kind of tricky catch-all category is tough. So even if you're in the U.S., you're not a citizen, you're not a permanent resident, maybe you were here on a work visa or a travel visa or an investment visa like an L1, H1B, EB5, B1, B2. If you meet the substantial presence test, you're subject to U.S. tax on your worldwide income, just as if you were a citizen or permanent resident. So one of the first considerations is, what is the goal of coming to the United States? Is it to become a U.S. person for investment purposes? Do you plan on residing here full time? Is it because of marriage, et cetera, et cetera? So that's something you want to think about beforehand. Once you're a citizen or permanent resident, it can be difficult to unwind. If you're a visa holder, foreign national under substantial presence, there's the closer connection exception, and then you can just leave the U.S., not meet the substantial presence test in the current year, and it's not an issue. So the U.S. is one of the few countries on the that focuses on or uses worldwide income. So taxation model, CBT, it's citizen-based taxation. It's not limited to citizens. It includes anyone in the categories I just described. Basically what that means is the U.S. is going to tax you on your worldwide income, require you to report and disclose foreign assets, accounts, and investments, no matter what. So you could be a permanent resident. This is a common situation we deal with. Permanent resident, left the U.S. a few years ago, residing in a foreign country. All of the income is sourced from overseas. Most of the assets and income, investment-wise, is overseas, either in the country of residence, third-party country. Well, since they're permanent residents in the U.S., they still have to report and include this income on their U.S. tax return. Now, there's foreign tax credits that may be available, foreign earned income exclusion that may be available, but at the end of the day, it's a major tax headache for individuals who really have no other relation to the U.S. anymore other than they still have green card status. Very important. If you have legal permanent resident status, just letting your green card expire is not sufficient to give up your U.S. person tax status. That's another very common situation. People will contact us, hey, I just let it lapse a few years ago, I haven't done anything, I haven't filed. Well, from a U.S. perspective, unless it was administratively or judicially disposed of or relinquished, you're still a U.S. person for tax purposes. So here's a few important planning tips. One, decide how long you're going to be here for, and if it's worth getting your permanent residency, or would you rather just be on a visa. Sometimes they have a visa waiver, things like that, so that you can come to the U.S., not spend too much time here, get the benefit of what you want, and then leave and not have that U.S. person status. If it turns out that you do not have a green card, but you met the substantial presence test, and see if you can qualify for the closer connection exception on Form 8840. That's one way to avoid worldwide income and reporting, even if you met substantial presence. And if you did, you may also consider a Form 8833 treaty position on a whole host of different issues, depending on whether that will impact your U.S. person status. Permanent residents, okay, and citizens. If you maintain that status for too long, then the situation will be when it's time to relinquish or renounce, you may become subject to exit tax. that is if you are a covered expatriate. So if someone is here, only let me take a step back. If you only meet the U.S. person status because you met the substantial presence test, well, then you're not subject to exit tax, because exit tax is only for covered expatriates, and there's only two categories of individuals who may be a covered expatriate: U.S. citizen either by birth or naturalization, or a green card holder who has been a permanent resident for 8 of the last 15 years. It doesn't require that you reside in the United States. If you just abandoned the card without formally doing it, just letting it lapse, well, or voluntarily abandoning it is probably a better way to describe it. Well, then if you've had that status for 8 of the last 15 years, it can be a problem. You can be a covered expatriate. If you're coming close to that, you may want to consider an 8833 treaty position filing to be treated as a foreign resident, so that doesn't count toward your 8 of the last 15 years. If you're out of compliance already and you want to stay in the U.S., even if you don't, since the look-back period is 3 to 6 years, there's various amnesty and voluntary disclosure programs that are available to you, whether or not you're a citizen, permanent resident, or foreign national that met the substantial presence test. There's the traditional voluntary disclosure program, which is generally for people who don't qualify for one of the streamlined procedures, reasonable cause, or delinquency. It carries a bit of a heavier penalty than the other programs, but if you cannot certify under penalty of perjury that you're non-willful in your failure to comply, then traditional voluntary disclosure, aka new OVDP, is probably the only option available to you if you're going to come proactively and make a disclosure. The more common and popular programs would be the streamlined filing compliance procedures, broken down further into the streamlined domestic offshore procedures, streamlined foreign offshore procedures. Those are for non-willful applicants. The domestic carries a 5% penalty. The foreign is a complete penalty waiver. The domestic and the foreign refers to the residence of the taxpayer, not where the accounts or assets are located. There's also alternatives to streamlined. There's reasonable cause, the delinquency procedures, delinquent FBAR procedures, etc. My name is Sean Golding. I'm with Golding & Golding. This was an introduction to pre-immigration tax planning. I hope it was helpful. Thanks again. Have a good rest of the day.